Let's do it. Hi, everybody. I'm Toni Turner, and welcome to the Money Show. Are you having a good time? Isn't it fun? We owe a great debt of gratitude to the Money Show folks. It's based in Sarasota, where I live. I've known Kim Githler for 20 years, and it's a fantastic organization, and I'm proud to be a part of it, and I'm very honored that you all are here today. Now, let's get a couple of announcements out of the way quickly. First of all, I am going to ask you to turn off your cell phones, and because that's just, are you okay with that? Or you can talk outside, but we're going to get started now. So I would ask you to turn off your cell phones or put them on vibrate. Also, we did hand out these little, this form here is on Monday. We are going to, for everybody in the room who turns this in, and please write legibly, we are going to have a drawing, and whoever wins, my director of operations will be contacting you. You will be able to choose any of our online or DVD programs on toniturner.com as our gift to you. So if you'd like to participate, please fill out your name and your email address legibly. Some people kind of scribble. And there's a box in the back of the room, a plastic box. Can you step out, Mike, so we can see you? My husband is my assistant today. He came with me, so that's Mike. So if you take this slip, fold it, and put it in the box, we will notify you. Also, you will be on our mailing list. I do not spam. I do not sell my list. It's just once a week you will be getting the Market Now, which is simply my commentary on what's happened on the week and what I think may be happening in the future. And I give you an exchange-traded fund that I think may be starting, has a good pattern and may have a good reason to start higher. So it may be something you want to look at. I have a neighbor, he said the other day, he was with Ford for like 40 years. He goes, I just do whatever you say on the Market Now. And I'm like, oh my gosh, I don't want to hear about it. But anyway, I think you'll find it interesting. So if you'd like to sign up for that, you can. Also, because some of you may have to leave a minute early, I only have 5 copies left of our flagship product. This is 4 DVDs. It's called 7 Steps to Successful Trading. But this is truly a fantastic introduction. This is not day trading, although you can take it to that. But it gives you it gives you a full course on how to look at the stock market and things you really need to know in order to trade, not fast day trading, but a little longer term trades, and yes, to invest. So if this is something you would like, we're doing it at this show for like 50% off. My husband Mike has copies of this in the back. You're welcome to go back, and I only have 5 copies with me of 7 Steps to Successful Trading. So you're welcome to read this over. It does give you the setup we're going to talk about now. It does detail that for you so you'll understand it thoroughly. And there's a tremendous amount of content in this, handouts that you'll fill out, psychology, how to look at the market, just so many things you're going to need if you want to be a consistent winner. And after all, in this game, like in any game, consistency is what you want. You don't want to making $1 million one day is great, but losing it back the next day is no fun at all. And that's what happens to a lot of people who are new in the market. Getting in is easy. We have an account, we buy a stock, that's easy. Getting out, that's a whole different ball game. And the people who know when to get out are the ones that make money. And if they get out correctly, they know when to do it consistently. So on that note, again, Mike in the back of the room has those DVDs. Let's get going here. Today we're going to talk about how to swing trade successfully. And I'm going to give you 3 whole seconds to read this disclaimer, okay? You got it? 3, 2, 1. We're done. Okay. Okay, anybody in here swing trade now? Oh, good, good. You guys do. We got about half the audience who swing trades. Good. Anybody in here day trade? Really? Okay, cool. I didn't know Money Show. people day traded. That's so much fun. Trend trades. No, sort of, kind of. Yeah, I love trend trading too. Okay, so let's look at this. When we swing trade, what we seek to do with these trades is to take the center out of the Oreo. Prices go up and prices go down. Prices move up in uptrends. Who knows the definition of an uptrend? Higher highs and higher lows, right? That's easy. Okay, downtrend, lower highs, lower lows. So what we do with swing trading, and we're going to look at it, of course, is we want to take the center out of the Oreo. Okay, we're not going to get in at the very, very bottom of the price swing, because you only get to do that once in your whole trading career, and I did it about 5 years ago. Once. And then you're not going to get out of the top, because you don't get to do that either. It's just the way life is, the way the market is. But what you want to do is you want to take the center, what I call it, the center out of the Oreo. Now, the average time in a trend trade, and I like to use them in markets like right now, where I don't know, it's still bullish for sure, but we don't know if it's going to break down. We're kind of an iffy position here. We've got the S&P 500 has a lot of resistance up where it is now. And so it's kind of a good thing to have in your pocket to be able to swing trade and say, okay, if I'm in 3 days and I make a little change, I know when to get out and profit from it. So what you want to do with swing trades is you want to be, and we're just going to talk about long today, you want to be long the stock, or you want to buy the stock and hold the position while it's moving higher, and then when it starts down and profit taking come in, as it always does, you want to get out, take your profits, and maybe you stand aside for a couple of days and say, okay, I'm good, I'm going to see what happens next. Or maybe you've got 3 or 4 swing trades going, maybe more. But the point is you take the center out of the Oreo, and you don't want to give back your profits. And that's exactly our point to the whole thing. So this is a chart, a daily chart of Johnson & Johnson. Now, on this chart, it was red, but it turned pink somehow in here to match my sweater. The red or the pink line is the 20-day simple moving average. The green line is the 50-day simple moving average. These are commonly used moving averages that a lot of people do use. I use them too on my daily charts for indexes, not for trading. And you can use the 20-day moving average many times if price jumps up and off of the 20-day moving average. You can use that as it did back in here. You can use that as an entry point. Trouble is, what do you use for an exit point? Now, there are different things you can look at on a price chart that will give you a hint that price may be coming down. In this particular little first run up here, you're going to see that this is the 14-day RSI, and you're going to see that the stock all of a sudden, this line here is the 70 line on the RSI chart. It means it's overbought. It jumped up to that line, and you say it's getting overbought, meaning too many people own it, and it probably will start down. But it still doesn't, even with these major moving averages, you don't have much of a hint as to when to get out unless you've been trading for a million years and you just say the first big red candle, I'm out of here. And actually, that's a signal right here. That's a bearish engulfing candle. And you can say, all right, I'm taking my profits there. This move here, very nice, it jumped higher, higher, higher. Then little tiny candles will tell you maybe it's starting to weaken. And there's like 5, 6, 7 days in this move up. As long as that big red candle gives you a warning and get out, fine. But if you missed it, it's just there's really no place to give you guidelines as to when to get out of these particular swing trades. And you say, I looked at the chart and I said, well, heck, Toni, why wouldn't you stay in the 20-day moving average? Why wouldn't you just stay in as long as price is above that? And you can, but you don't know. You don't know. This is a very, very nice move up. Any moment now, Staples, which Johnson & Johnson is a part of, could roll over as tech stocks move higher. And this could have gone like that, or the market could have rolled over, and you go, oh my gosh, I just lost all my profits. So that's why I want you to have better guidelines than just common moving averages for your swing trades. So let's go on here and look at Cinemark Holdings. This is another example of, even down here, prices moving in a downtrend. When it's down here, do you really want to take that chance? And you can, that you get into a swing trade here. You could, but it moves up dramatically and then falls like a stone. Do you have any guidelines to tell you when to take profits? And that's what you want, especially when you're in the heat of trading, when the market is going bananas, and some days it does. You know, it's very hard. Can you imagine putting a fighter pilot into a, what do they call them, F-18 Tomcats? Is that anywhere close to right? And they're not trained. They don't know when to zig and when to zag. Not a good idea. And many times in the market, we feel like we're in an F-18 Tomcat or whatever. It's like, whoa. You need a simple, I'm a blonde, I need simple. You need simple guidelines to say, okay, when this happens, then I do that. When this happens, I do this. Instead of having to read these particular patterns, and they happen so quickly. So that's what I'm doing with my Sleeping Tiger setup. Here's another example with Mednax. It flew up here. Could you have gotten in there? Absolutely. Then we had a big high wave candle, which could have been a bad tick. And then we had the usual engulfing candle and start back down. If you're smart, around and started right back up again, and I left all that money on the table. So once again, but it didn't happen. It fell back down. You need stronger guidelines for your swing trades. Now, does anybody know, I just captured this here because I thought it was interesting. Does anybody know what happens a lot of times with price patterns when they consolidate like that? They just go sideways. They don't go anywhere, and it happens. Does anybody know what usually happens with What usually happens with patterns, Go ahead. Okay, what can happen here a lot of times, this has been consolidating since August, September. For 2 months, it virtually went sideways. Unless there's some really good news, like good earnings, or somebody purchases them, what happens is that traders and even some investors say, this is dead money and I'm tired. And traders get tired because it's not going anywhere. And what usually happens is it falls. Now, if this had been farther up in the uptrend, if this uptrend had moved like this and then it went sideways for a while, even then. So I would suggest, if you're in a stock and it's doing that, I would suggest you find the low of the consolidation. And at this point, it's about $45 and change. And I would suggest that you enter what we call a hard stop with your broker. Because if traders get tired and the market starts down, they will sell that thing like crazy, and the shorts will come in, and they will pound it. So when you see it going on, this is total indecision. I don't know. And look at this candle. It moved down. Now we're in a lower, we're on the first floor, or we're on the lower lobby instead of the first floor here, or the lobby. You see how it's gradually moving down? Just something I wanted to warn you about. Traders lose interest. We're a very fickle group. And so something I thought you might want to keep in mind. So let's talk a little bit about the Sleeping Tiger setup. That's what I wanted to show you today, to give you better guidelines as to, if you are swing trading, where to get in, where to get out. I developed the Sleeping Tiger setup in, anybody remember the market falling like a stone in 2009? Remember how it went down so hard and fast? Remember, I had the hedge fund manager down the hall. He came into my office. He was pure white. He said, Toni, the bond market seized up. Bond market's a lot bigger than the stock market. He was white. He was in agony. He had a lot of clients. We were all scared. And if there's anybody in this room who started buying stocks at the very bottom, we're going to bring you up here and give you flowers, because maybe a bottle of champagne, because most of us who were deeply immersed in the market, with guys like coming down the hall, hedge fund guys, pure white. Actually, he was kind of gray and yellow, and he was like, nah, we're toast. We are absolute toast. It was a scary, scary time. And when the market started up, I decided to invent a setup that would help me, and then I spread it out to other people that would keep me in a trade but not keep me in too long at swing trading. So I developed the Sleeping Tiger setup, and what I had in my mind when I developed it was I pictured a tiger, a very svelte, tough tiger, laying in the jungle, laying in the reeds, and he's kind of sleeping, and then his prey walks by. He jumps up, he grabs it, he brings it back, he eats it, and he goes back to sleep. And that's kind of what we're doing with this setup. We're watching for a really good one. We're jumping up, we're grabbing it, we're taking our profits, then we're getting back out and looking again. So what we want with the Sleeping Tiger setup, we're going to use the 8-day simple moving average and the 13-day simple moving average. Now, I always keep the 50 and the 200-day moving average on my charts because I want to know where they are. They're used by institutions, and I think they're important. On the charts I showed you, I took off the 200 days so it wouldn't be so confusing, so you could see it better. But that's up to you if you put it on. And this particular setup, the 8 and 13, are very important. And we're going to look at charts of this. But what I like to see is a stock that's either been basing for a while. You know what a base is. And the 8 and 13-day moving averages start moving up. And this stock is nestled in, I'm going to call it, or cradled in, or just atop the 8 and 13-day moving averages. This is usually in a consolidation phase, although I wouldn't have used the one I just showed you. That would not, to me, be a good entry, the one where I said that usually falls. I'll show you a good example. What I want here is the 8-day moving average poised just atop the 13-day, or just coming up and crossing above the 13-day moving average. And when or if the stock breaks to the upside, then we buy a position. Now, again, because I like simplicity, I started trading in a trading room back in a trading room in New York. We used to have trading rooms where a bunch of people came in. We had monitors. We sat in our seats. We punched out day trades all day long. Sometimes I made 200 trades. So I wanted something simple so that I didn't have to think hard when everything was in chaos around me, when the market was in chaos and I'm looking at a whole bunch of different things. So this is easy. This is really easy. Our goal for our trades, our swing trades, is for our stock to walk up the 8-day moving average like it's a staircase, right? Now, what we do and I use this in Toni's Market Club, have been for 11 years. Toni's Market Club meets every Monday, and you can go to toniturner.com and see it. What we want to do is when the stock's moving up, and we'll look at it, walking up the 8-day moving average, when it starts down and closes is the operative word here, below the 8-day moving average, you take your profits. Now, how do you know? I don't know when it closes below it. Look at a chart 5 minutes before the market closes or 10 minutes before the market closes. Is that stock below the 8-day moving average? And if it is, you want to take all of your profits, or say, well, I want to stay in a little longer. I still think this has got some juice. Maybe you take half your profits when it closes below the 8-day, and then maybe you take your remaining profits when, and I'm going to say when because it will happen eventually, when that stock closes below the 13-day moving average. So you can use, I'm surprised at how many times stocks will come down, close below their 8-day, and then continue, and then come down to the 13-day and then bounce. So you've got that You got that little bit left there. It's a what if kind of thing, and it could just keep right on going. Okay, so this is the same Johnson & Johnson chart, but now the pink line, it turned pink, is the 8-day moving average. The blue line is the 13-day moving average, and the green line remains the 50-day moving average. Now, something happened. Am I going too fast for everybody? Anybody? Okay. Something happens that I want to tell you about where I kind of alter my plan for I don't alter it, but I kind of scoogee over on taking stops. Do you see, I want my stock to walk up the 8-day moving average. In every single case here of these jumps, Johnson & Johnson, except this top one, pretty much, Johnson & Johnson has jumped way up above the 8-day moving average. It's not trading, it's not walking along it like a lot of stocks is. It's up here, right? Okay, so what I call that is I call that liftoff because it's trading at a premium to its 8-day moving average. Now, typically when a stock starts in an uptrend, the very best angle you want for it to remain strong is not this, but it's this, more of a 45-degree angle. But when stocks move up real high, I mean Johnson & Johnson, my gosh, you think that's conservative. This is not Amazon. What's going on? But it has the power to do it. So what I do, if it starts lifting off like this, this is when I start raising, when it's in liftoff, I'll start raising my stop below the low of every day. I'm tightening it up. You get it? Now you can fudge. You can say half my account every day. I'm going to raise my stop. I'm going to let it form for most of the day, and then I'm going to raise my stop to just under the low of the day. And that way, you're really tightening it up, because if it's trading like this instead of like that, it won't go as, can you run, how far can you run as fast as you can go? How long can you do it? A shorter period of time than you can walk, right? You could maybe walk 3 hours at a time. But if you're running as fast as you can go, you might make it for 3, 4, 5 minutes, and you got to stop. Stocks are the same way. When they get going like this, why? Because profit taking comes in. People want to take profits. I want to take profits. You say, heck, I just made 3, 4, 5% in 4 days. I'm getting out, maybe 10% on some of these wild things. So that's another avenue you can take if you want to do it, is start, when it goes into liftoff, start raising your stop, raise your stop, raise your stop. This day it came down, went below that low. We call it the low of the high day, and you say, I'm out, right there when it does that. And you've got all of this right here. Now, okay, let's go on and look at another one, swing trades in action. Now, this, please do. I'm not buying that. Now, the 8 days, you mean up here? On this run up? Here? You can, yes. Yes, oh, absolutely, if you like the pattern. And you say, oh, good, it's going to keep going. It could have rolled over here for a lot of reasons. It could have rolled over on earnings. It could have rolled over because of the market. It could have rolled over because staples are falling. You know, when tech stocks are going bananas, nobody cares about staples. I don't do options, but you could. But you could do options. You could sell call. Or I do stocks and ETFs. Yeah, but you could. Who else? Does everybody get it over here? Low. See, what you're trying to do here in any of these examples, what you're trying to do is not give any money back. Now, when you see big candles like this, well, I used to say, we love it, we love it, we love it, we're not sure, we hate it. All right, think of this. Think of the, I have this sidewalk theory, I call it. So you got a basketball, and you're holding it in your hands, okay? And you're standing on a sidewalk, and you take the basketball, and you throw it down real hard. It bounces. When it starts up off the sidewalk, where does it have the most momentum? Is it bouncing off the sidewalk or when it's hovering at your waist? Bouncing off the sidewalk, right? Where are the most buyers? When it starts up, because you and I know, here, see how it's cradled in or nestled in? The 8 and 13-day moving averages are together. See, the 8 crossed over the 13. You're in an uptrend. We got that. 8 crosses over the 13. But this is so nice with it bouncing off the 8-day. So here's the basketball. Here's the sidewalk. It's got momentum. People are going, Johnson & Johnson's breaking out. Johnson & Johnson's breaking out. Woo-hoo-hoo. And then up here, we're going, okay, that's enough profits for now. And we get a big dark cloud. Also, what you have here, if you put the 14-day RSI on your charts, you're going to see that this is overbought. Now, RSIs can get overbought like this one did and stay overbought for a long time. But when that line pokes above the 70 line, the overbought line, on a chart, as it has recently with some of our indexes, when it actually goes above that RSI, usually you're going to get a pullback pretty soon. I mean, you just do. It just happens. That's what this is for. So if you put that on your screen, it really, really helps. But, okay. All right, go here first and then there. This? Yes. Well, that's a good question because, see, it didn't close below the 8-day moving average. It didn't close below it. Now, if you want to say, hey, that's close enough for me, that's fine. That's fine. Then it bounced for 2 days. Then it closed below the 8-day on this day. And you would have actually made a couple more cents if you'd stayed in. Then if you sold half of it when it got here and then held it, in this case, it did keep falling back down. So you would have had to sell the other half of the position when it closed below the 13-day. Now, look, if we get an announcement in the market that the asbestos? Okay, all right, there you go. If that happens, or if we get an exogenous shock, North Korea's really ticked and they sent off another rocket or something, and the market starts down dramatically, you don't have to wait till it closes. Just use some common, there's common sense too. Just get out, okay? You put in a, I do it so often, I don't know what it is. You put in a stop market order is what they call it. Yeah, and because a limit order is a whole different thing. You can make it a limit order, but on your broker screen it should say stop market order, something like that, and make it good till canceled, unless you just want to make it for the day. Sir? Well, it is just, I said, if it's in liftoff, if you're talking about this one. Go back here. Here. If it gets, no, if you had been following the raise your stop, absolutely. If you don't. In this case, when it's moving up in what I call liftoff, then when it broke the low of this day here, the candle below it, no, I would get out. Well, it could gap down. No, I like to just get it done. That's personal preference, but I don't know where it's going to open tomorrow morning. You can do that if you like to do it. A lot of people don't understand it or like it, but you can trade after hours if you want. I just, I mean, that was a really sweet move, and I'm good with that. Sometimes you can make yourself nuts trying to get out in at the low and out at the high, because you just make yourself crazy. This is a negative pattern. It has engulfed the last 3 candles before it. I would say this run is over. Now, it's certainly up to you if you want to keep it, but for me, that's a successful swing trade. I have taken the middle out of the Oreo. Okay, and I did it with the stock and liftoff, which means it's straining a lot harder than it would have been just walking up the 8-day moving average in a nice order. This is liftoff too, in a way, but it's still a nice orderly pattern where it's just walking through the park here and it's above its 8-day. That's fine, but for this is a lot more dramatic right here, and I'm saying, hey, this horse has run hard enough, long enough. Thank you, sell. I care very much about earnings announcements. Yes, I very much do. And I announce them in Toni's Market Club with everything that every trade that I talk about. Okay, so we're in good time here. So the sleeping tiger setup works well when the markets draw down and when they drop, as they did recently. We all know that the market fell like a stone off a cliff down to the lows on Christmas Eve day, right? December 24th. The S&P 500 fell to 2380, I believe, and closed there. And it was like, oh boy, here we go. And then miraculously, on December 26th, it opened. That was the V bottom, and it started back up. Now, I didn't know it was going to rise up so dramatically. There are people in the world who will tell you that they know where the market is going next. Okay? You want to ask them why they are not sitting on their yacht in the Mediterranean drinking champagne. Why is that? Because nobody knows where the market's going next. I don't care who they are. It just ain't going to happen. And so I certainly don't know where it's going next. I know what I kind of think through my experience and by reading charts. So I didn't expect these moves to be so smooth, but here we have Fifth Third Bancorp, and this was the pattern of many of the banks. They have recently, even with interest rates rising, and that's good for banks for interest rates to rise. Why? Because their product is money. It's like if you were selling ice cream cones, your product is ice cream cones. The banks are selling money. Their product is money. So if interest rates rise, they get more money for their product, which is money. Actually, interest rates, I'm going to tell you right now, mostly rule the world. The cost of money is what interest rates are, and most of the time that moves, no matter what nefarious position a lot of these crazy people are around the world who are going out and hurting people, most of the time it has to do with making money. So that's important. So a lot of the banks, was a little puzzling to me, fell pretty hard as interest rates were rising, but then we had this uncertain period in the market, and we know that most banks fell, but a lot of them, and I like regional banks. Number one, if it looks like now they're going to back off on their interest rate, the Fed's going to back off, regional banks tend to make the most home loans. I like the orderliness of regional. A lot of the regional banks have orderly charts. I like orderly. I like because it gives you some better idea of what to expect. And Fifth Third Bancorp has a pretty orderly chart. It was trading, it was consolidating here. Here's one of those consolidation periods where we think it's going to break out. It tries, but it can't. See, people get tired. I said, this thing's going nowhere. I'm selling it and getting something else. So it came down from these highs up around 29.50, 30, came down to 24, sold off hard once again. But the whole market, you could watch the S&P, and if you're getting into banks, do yourself a favor, or any other sector, industry group for that matter, watch the ETF where it lives, where it resides, the sector or the industry group ETF. And I'm going to show you in a minute where you can get them all off my website for free, okay? So if you watch the the XLF, which is the Select Sector Spider Financial ETF, you would see that it's pretty much doing the same thing. It's like your little crystal ball. So you can watch the S&P 500, which is important with banks. You can watch the XLF. I always give myself 2 little crystal balls to watch. They'll give me a hint as to where my stock's going, the S&P 500 and the industry group or sector where it resides. So the FITB came down like, oh dear, what a mess. Came down to these lows, 22. That's several percentage points off its highs. Rallied down here with everybody else and then started up. And I say, I wonder what FITB is doing, because it's always, most of the time, it's a pretty orderly stock. So here's the, now you could say, you say to yourself, I know I am bottom fishing here. I do not mess around when I'm bottom fishing. I always put in my protective stop, because if it starts up and rolls over, the short sellers will come in and pound it into the ground. So I always use a protective stop. But when I'm right, I do really well. So the 8-day came down here, crossed up over the 13-day. Right at this point here, FITB broke out. This was a perfect entry. Now you had to look at the 50-day and say that might be resistance. But down here at 23.50, I'll worry about that in a couple of points from now. So FITB rose up, and now all you have to say is, as long as FITB, as long as Fifth Third Bank Corp. is above the 8-day moving average, I'm a happy camper. So you look at it maybe once or twice a day, and you say, yep, it's still above it. I'm a happy camper. It came in right here. You say, whoa, it consolidated a little, but no close below the line. Line is very steep. Now, when you see it rising up into liftoff, you say, all right. Always look left. Where's the last resistance? Where are the mad people and the angry people that might sell, that say, oh my gosh, if this stupid stock ever gets back up to where I bought it, I'm going to sell it and get out even. Nobody in this room's ever said that, right? The oh my gosh part, or the I'm going to sell it, or other words to that effect. Doggone this stock. So yeah, so it came right back up. Look left to prior resistance right here at ballpark 28.50. It gets back up to that point. This is where a lot of people are going to say, I'm getting out even. And you've got this in liftoff now, and you say, you know what, I'm going to start raising my stop, because I'm doing so well on this, and this has been so easy, but it's in liftoff now, and it's getting at a higher and higher premium to the 8-day moving average. So I'm going to be wise here. I'm going to lift my stop up. So either you did that, or you just said, no, I don't care. If it's above the 8-day, I'm good. You can use either strategy. Right here, it closed below the 8-day, and if you got out at 27.50, I'm going to call it, you made a 17% profit, but you made it with no muss, no gut grinding, no, oh gosh, what's going to happen next? Because it did just what you wanted. It walked up the 8-day moving average. Is every stock so cooperative? Certainly not. But in this particular move here, a lot of stocks did just this. If it had rolled over here, you still would have made a profit. As long as you mind, it's walking up the 8-day moving average. And then it gradually fell down the next day here and broke the 13. But you still had a really good profit. Okay, I got to finish this up here, although we don't have the next group coming in until 3:30. But yes, I know, I got to finish it up. Okay, so here we have a company, FND is the symbol, Floor and Decor Holdings. And Tony's Market Club, partly my fault, Because when I was in that trading room with about 15 guys in New York back in the 1990s, I have a real high tolerance for risk. It's nothing you develop, it's something you're born with. You have it or you don't. So I was able to day trade the wildest, woolliest stocks back then. But you can get smacked around so much by the market that you get over wanting to trade the wildest, woolliest stocks. And so in Toni's Market Club, we aim for middle of the line. We pick a lot of stocks out of the S&P 400. I believe Floor and Decor Holdings, FND, is one of them. Also, if you look at this chart, you can see how orderly it is. I like orderly. I make more money with orderly stocks. And I think you will too. You see, it doesn't hop all over. See what a nice line? I mean, that's even the move down is orderly, and usually that's trends moving down are a mess. But now we've got Floor and Decor Holdings, which will do well if regional banks are moving higher and home sales start up again. We've got, what do we have here? What's this pattern? Thank you. It's a double bottom. Now, it's only a double bottom when price comes up and moves above these, excuse me, these highs in the middle of the W, which is 35 and change. But we'll say it's a double bottom. It legally did it. And so right down here, you say, hey, it moved up, it did that, it held these lows, it held these support lows, it's starting up again. Very nice. We know there's buyers here. There were buyers there. Now we know there's buyers here because they're holding it up. And here's a nice doji, and it starts up. The 8 crosses over the 13. It's cradled in. We say the 50 days up here, not too far away. So maybe I buy half my position here. Maybe I buy a small position here and see how it's going to do moving back up through all these scared and mad people. Let's do that. And maybe I buy half a position here, or more if you want, and watch it, see if it can move above the 50-day, which it did. It's in liftoff above the 8-day moving average. It comes down, it has a scary day that probably is earnings, and I don't like to stay in through earnings. They're not a very big position. But it didn't close below the 13. So if you still had half of your position left, then it walked back up the 13-day. You could add back in if you wanted here, because it got over that little temper tantrum, and you came in and it closed below the 13 here, and you made a 24% profit. You see how you think? But if you just use the basic that I taught you, the basic 8 and 13, close below the 8-day, half or all of your profits, close below the 13, all your profits. Get it? Then you've got a structure for your trades. And if you use liftoff, if it trades at a premium to its 20-day and you keep raising your stop, you're going to make money. And what you want to do, if you made $15 on a trade, it's still a good trade. Okay? You made some money.